Hey guys, I'm Bryson, and the more videos I make about investing, what I invest into, how to buy a stock, where to go to buy a stock, I keep getting asked this one question in the comments, and that's basically, tell me, how do taxes work when it comes to investing in the stock market? Do I pay taxes on my dividends? Do I pay taxes when I hold an investment, or is it when I sell an investment? How does everything work? And in this video, I'm going to break that down. And one thing is this, guys, when I was in college, the teacher always assumed when they answered a question that I basically knew what they were talking about, and I didn't know. So after they answered the question, I would always have a bunch of more questions, and I would be just more and more confused. So in this video, I'm going to assume you know nothing whatsoever about taxes and also investing. That way you know exactly how everything works step by step, okay? That's the goal for this video. Now, if you guys are new here, I post videos every single day, so make sure also subscribe and hit the bell so you're notified, and on top of that, also destroy the like button. It helps a lot with the channel, so thank you guys so much. And by the way, we're almost at our goal of 250k subscribers by the end of this year. So if you're new, subscribe, okay? Let's get to that goal. Now, the first thing is this, guys. I want to make something very clear. Whenever you buy an investment, usually you have nothing to worry about when it comes to paying taxes on it unless you actually go ahead and sell that investment for a profit. Because basically, the government only cares when you go ahead, you either receive money from dividends, or for example, you sell an investment for a profit and then they want to go ahead and tax you on it. So if you hold an investment right now, in reality, you don't have to worry about taxes until you either get paid dividends or, for example, you go ahead and sell that investment. So if you're just holding on right now, don't worry about taxes. Now, when it comes to investing in the stock market, there are two types of accounts. You have a taxable one, and then you have one that's basically for retirement, and it doesn't charge you any taxes whatsoever because Uncle Sam wants to make sure you can actually survive for retirement, so they give you a whole bunch of benefits. That way you can avoid taxes on it, okay? So, for example, guys, okay, currently right now, I have a retirement account, and I also have, for example, a normal taxable account. The idea is that if I go, for example, into M1 Finance, which I do invest into, by the way, my portfolio is linked down below. The idea is that this investment portfolio right here is taxable. So my dividends are taxable. If I sell an investment, that's also taxable. But for example, if I have a Roth IRA, a 401k, or maybe even a Roth 401k, the idea is that whatever my gains are inside of that portfolio, inside of that account, well, they're not taxable even if I sell back and forth to do whatever I want to do in there. The dividends I actually make also in that portfolio is also not taxable either. The whole goal of that is to basically have your money grow tax-free, so for retirement you can actually have enough money. And those are the benefits of going ahead and investing also into a retirement account, because your money gets to grow 100% tax-free. That's the cool thing about it. However, if you go ahead and invest, for example, a little quote here, into a Roth IRA, you invest your after-tax money. So once you turn 59, you can take the gains out and everything out 100% tax-free. But if you invest into a 401k, you actually invest your pre-tax money, meaning you never pay taxes on it before you invest it, meaning when you want to take that money out when you're 59 and a half, they're going to charge you the taxes you should have been charged. But until then, on both accounts, your money is growing 100% tax-free. And my strategy is usually I do both. I max out my retirement accounts, and then I go ahead with the extra money and I put it into my normal taxable account, but I don't sell anything, so that's one thing I don't have to worry about. But the dividends I do get paid for being an investor, well, I do have to pay taxes on that, and that's what I'm going to talk about in this video also. Now, number two, so far we know you have the taxable account, also a retirement account, and that you only get taxed on the money you actually make when you actually sell an investment. So if your Apple stock went up by 20%, you're not going to be taxed unless you actually realize that gain by going ahead and selling your investment. That's the core idea. So what type of tax do you get taxed when you actually go ahead and sell that investment? Well, the IRS basically has two forms of taxing you on this stuff, and it's basically called capital gains tax. But there's long-term capital gains tax, and there's also short-term capital gains tax. Tell me, how exactly does this work and why do I care? Well, the answer is that long-term capital gains tax is taxed at either 0% or, for example, 15% or, for example, 20%, but no more than that, okay? It means that it can't go beyond anything else except between 0 to 15 to 20%. That is it. However, when it comes to short-term capital gains tax, well, you're actually going to be taxed as ordinary income. So for example, if you are in a tax bracket around 40% or 38%, the idea is all that income is going to roll over into that and you're going to be taxed at that exactly. Now, tell me, how do you consider long-term capital gains tax and also short-term capital gains tax? Because obviously, I want the long term. That way I can avoid a huge tax bill. Well, the way the IRS looks at it is basically if you hold the stock for more than 1 year, that's long-term capital gains tax. If you hold it for less than 1 year or equal to 1 year, that's short-term capital gains tax. So say for example, I went out there and I bought some stock in Apple, because everyone loves Apple. We all know this, man. They're worth like around $2 trillion right now, right? Crazy company. But the answer is January 1st, I went ahead and I bought some Apple stock, okay? I bought 1,000 shares of Apple stock. Crazy amount of money. By the way, this is an example. It's not real at all. 1,000 shares of Apple stock is like almost like $100,000 worth of Apple stock, okay? So just keep that in mind. Wait, maybe even more. A lot of money. That's the point here. Apple stock right now is trading for around $109. So 1,000 shares of Apple stock would be like around $109,000. So again, let's just go back to the example, but I just couldn't resist telling you exactly what the real numbers actually were, okay? But let's say, for example, I bought 1,000 shares on January 1st, and I basically held onto it until January 1st, and then I sold it that same day. Is that short-term or is that long-term? In reality, guess what it is? It is short-term because you're supposed to hold on to it for more than 1 year, not equal to or less than 1 year. So in this case, whatever I sold that Apple stock for, even if I made, for example, $1,000 extra or $1 million extra, in reality, that would be taxed as ordinary income, and I would have to pay a lot of taxes on it. However, if I held on to it just for one more day, not January 1st, but instead January 2nd I sold, 1 year plus 1 day, the idea is I would be taxed as long-term capital gains tax, basically between 0%, 15%, and also 20%. Now, you're probably wondering at this point, Tommy, well, how do they consider if you're at 0% or 15% or 20%? Like, how does that work? Well, just like you get taxed, for example, like, hey, if you make less than 40K, you get taxed at 12%, whatever it is, that's the same way they figure out your capital gains tax, okay? So I'm gonna show you exactly how it actually works here. So let's say, for example, there's a sheet right here, by the way. Let's say, for example, you are filing right now your taxes as a single individual. So basically, you're not married, and that's what you're doing right now. Same here, bro, okay? Don't worry about it. Or sis, doesn't matter. But the idea is that if you make between $0 to 40K, in reality, you will be taxed around 0%. Awesome. Meaning you can actually sell your investments right now and pay no taxes on it as long as it's long-term capital gains tax, okay? Just keep that in mind. But let's say, for example, we make between $40,000 and $1 all the way up to $441,000. Well, in reality, you'll get taxed at 15%. That's where usually most of you watching this video are going to be taxed at. But when I was in college, I was being taxed right here, bro, at 0%, and that felt awesome. But say, for example, you make a lot more money, well, you're gonna be taxed all the way up to 20%, but it is a lot less money. And there's also, for example, if you're married and filing jointly, it's a little bit more different. If you're the head of a household and filing as that, it's a little bit more different. And if you're also married and filing separately, it's a little bit more different. Now, if you wanna go through these options right here, I'm going to put a link down below. That way you can see it and compare it, depending if you're filing single, head of household, married, filing jointly, or for example, married, filing separate, okay? I'm gonna put a link down below so we can figure out everything. Now, you might be thinking, Tommy, well, this is no big deal, okay? 15% or 20% doesn't really matter. But in reality, I wanna show you what the big difference would actually be here, okay? Because basically, say for example, you were actually taxed as ordinary income, and let's say you make between 85K to 163K, you're gonna be taxed at 24%. But you have to remember, guys, that basically whatever your income is, plus what your net profit was from selling that investment, the idea is they're going to combine those two and then put you in an appropriate tax bracket, which is usually going to charge you a lot more money, between 10% all the way up to 37%. So that's why usually you want to go with long-term capital gains tax. And by the way, if you are a day trader and you want to do that, the idea is that because you're selling every single day, every single month, at the end of the year, you're going to be taxed as ordinary income and you're going to pay a ton of money on taxes. Now, a simple way to do this, if you don't even want to think about it, just go right here to this website. It's called Smart Assets, and it calculates exactly what your capital gains tax is actually going to be. So for example, say for example, I invested $109,000 into Apple stock like I did. Now, the idea was that I actually sold this investment for around $200,000, okay? Almost 100% profit. Apple did amazing this year. Oh my God. And I basically sold it in less than a year, meaning, again, that's going to be short-term capital gains tax, less than a year, right? So I live in New York, and I also make $80,000, which puts me in a tax bracket of around 22%, right? But in reality, because I made $100K basically in net profits, in reality, that puts me in a whole different tax bracket also. Which means, okay, if I'm filing single, by the way, it means I'm gonna pay around $30,000, well, $30,877 when it comes to capital gains taxes, including, for example, federal taxes, state taxes, and also local taxes, because again, I do live in New York. However, let's say for example, I actually held this for more than a year. In reality, I would go from $30K all the way down to $23,000, which basically saves me around $7,000, and I'm only taxed at a 15% marginal tax rate. That's the awesome thing about long-term capital gains tax. But again, New York tax and state tax are so much. But let's just say, for example, guys, I went ahead and moved to Florida, a state that doesn't have any income taxes. Well, in this case, I would only pay $13,000 because basically there is no state taxes and there is no local tax. But some states do charge some form of capital gains tax, so keep that in mind, speak to an accountant. But the idea is that basically I get to save a ton of money if I switch states, but also if I hold on for more than a year. And that's the big difference when it comes to long-term capital gains tax and short-term capital gains tax. And by the way, guys, overall, capital gains tax is a tax you get whenever you buy an asset for a price, $100, and then sell it for more than what you bought it for. So in this case, $110 or $20, that's what you're gonna get taxed on, okay? Not the whole amount, but basically only the profit of $10. And by the way, whenever you actually have a loss, it also works on the way coming down. So basically, the government allows you to deduct that loss from your income also. So for example, but it's only up to 3K, and if you lost more than 3K, you have to transfer over to the next year, and the next year, and the next year. But if I lost, for example, 3K, well, it lowers my taxable income by $3,000 also. So it also works when you're making money, and also works when you're actually losing money also. But always, long-term capital gains tax is the way to go. Now, the second type of tax I actually want to talk about is basically dividend income. And today, I actually got paid some dividend income for my investments. You guys want to see? Here it is. If you look right there, I got $33 and also $15 right there. And that's awesome because when I first started out, I wasn't really getting any like double digit stuff, but eventually it keeps adding up and adding up. And dividends is definitely awesome. By the way, if you don't know what dividend is, it's basically whenever you invest into a company, they can choose to do two things: give you a percentage of the profits every single 3 months, every quarter usually, or every month, depends on them. Or for example, they keep the money, reinvest it, the value of the stock grows, and that way you get paid in a way. But usually you get a percentage of the profits, and that's called dividend income by being an investor. Now, the same thing works around when basically it comes to taxes when it comes to dividend income. You have ordinary dividends, and then you also have qualified dividends. Now tell me, what is the difference here? Is it just like long-term capital gains tax and short-term? The answer is yes, in a way it is, but it is a little bit more complicated, and here's why, but I'll make it simple, don't worry about it. The answer is that basically, when it comes to qualified dividend income, the idea is you're going to be taxed on that income like it was like long-term capital gains tax, between 0 to 15 to 20%. But if it's ordinary, they just roll it over into your income and you'll be taxed usually a lot higher. Now tell me, what makes my dividend qualified and what makes it ordinary? I want to know the difference. That way I can save a lot of money. Now, usually if the company you're investing into is local or domestic, for example, in the US, and it qualifies, and most of them usually do, and if you don't know, just do a quick Google search. For example, is Apple dividends qualified? They'll tell you yes. And the idea is that for your entire dividend to be qualified, you have to have the company be qualified for it, and on top of that, you have to meet the holding period. Meaning that, for example, you can't invest into a company today, $1 million, get tomorrow some dividends, and be like, hey, this is qualified dividends, oh my gosh, I'm good to go, I save money in taxes. In reality, the government is not stupid. You know that, we all know that. So what they do is basically, they ask you to hold that stock for at least 60 days before you get paid dividends, and then it's going to be considered qualified dividends. But that's only if you have common shares. However, if you have preferred shares, it has to be 90 days before, and then it can be qualified dividends. And by the way, if you don't have a domestic company and they have to be, for example, a foreign company, in reality, they have to be qualified and meet the regulations. That way they can actually be considered qualified dividends. So just again, do a quick Google search in the company you're investing into, and that way you find out if it's qualified or not qualified, okay? That's the whole goal here. So for example, say I actually got paid some dividends from Apple, and Apple gives their dividends around September time. Well, if I invested 2 months prior or 3 months prior, maybe back in March or April, the idea is that that dividends will be considered basically qualified dividends. But for example, if I invested into Apple September, gave me dividends, but I invested just in August, a month before, that's going to be considered ordinary income. That's the whole thing. But if I do have preferred shares in Apple, the idea is I have to be invested for 90 days equal 3 months. 60 days equal 2 months, but that's only for common shares. Most of us here are just investing into common shares, so just keep that in mind. Now, for example, guys, most of what I do is invest into ETFs, okay? So when you invest into ETFs, you have to go, for example, with Vanguard, Fidelity, Schwab's, whatever you do, BlackRock. The idea is you have to go to their website or contact them and find out exactly what percentage of your portfolio or your ETFs is considered qualified dividends. So in this case, if I go to Vanguard, it'll tell me exactly, let me just zoom in here so you can actually see here. It'll tell me exactly what percentage of my entire ETF is going to be considered qualified dividend income. So remember when I showed you the companies I actually got paid dividends from today? Well, in reality, one of them is called Emerging Markets ETF by Vanguard. And here it is right here. I got paid around $15 or so. So if I go on the Vanguard website and I type in, for example, Vanguard ETF qualified dividends, this right here is going to pop up. Again, all the links are down below. So if I type in, for example, let me just find here, right? Emerging Markets, and here it is right here, but it's not this one, it's actually the second one right here. This is my investment here. Well, only around 38% of my investments in here, my dividends, is going to be considered qualified dividends, okay? That's the point, because it's also not domestic but foreign companies, and not all of them qualify for being qualified dividends. However, I also have invested, for example, in the S&P 500 by Vanguard, and in this case, 100% of them are basically qualified dividends, because basically it's all domestic companies and they all meet the qualifications. So overall, guys, okay, the point is that when it comes to investing into ETFs, you have to check with the ETF brokers you're investing into and find out basically what percentage of it is going to be considered qualified dividends and what percentage of it is not going to be considered qualified dividends and it's going to be considered ordinary dividends. And by the way, if you don't want to do this whatsoever, every single year, your broker is going to send you something called a 1099-DIV form. That's going to tell you exactly your dividend income and what percentage of it was actually qualified and which one of it was actually not qualified. That way, you don't have to look it up if you don't want to, but I highly recommend before you invest, you look it up and you find out. So far, guys, we found out exactly capital gains tax, long-term, short-term, qualified, and also ordinary dividend income, and also that you don't get taxed as long as you don't actually sell your investments. But overall, guys, those are the basics when it comes to taxes and the stock markets and how it actually works. But comment down below, guys, and let me know, how long have you held a stock for? So it's gonna be long-term or short-term. And on top of that, what's the most dividends you gotten paid so far? Comment down below, let me know. I want to know. And if you want a more detailed video on taxes when it comes to stock market, comment down below and I'll get to work on that also. But if you enjoyed this video right here, guys, well, like this video. If you're new here, subscribe to the channel and hit the bell so you're notified. And if you want to talk to me about taxes and stocks and how I invest, what I invest into, join my Patreon, link down below. Or for example, just DM me on Instagram at Bryson. I'll see you guys tomorrow. And if you want to learn the basics about investing, here's a great video on it. And also, see you guys tomorrow. Thanks for watching. And as always, peace.